Up, Dan, we're live here on YouTube. It sounds very dramatic, doesn't it? Hello, I'm Paul Archer. Welcome to our live stream. You've joined me actually just whilst I've been doing recording all morning in the studio on our new protection qualification exam. So we're doing a portal, a boot camp for that. So I've been doing loads of recording before it gets too hot because it's pretty hot out there. So I thought, well, okay, rather than just stop, let's just give you one of the videos live on YouTube. So you're enjoying this one. But I'm looking at another camera rather than you today. So bear that in mind because I'm looking at an HD camera that records accordingly. Anyway, let's talk about the topic that I've got for you, which is quite a technical one, really, because we're talking about protection qualifications. And this one goes by the name of shareholder protection insurance. Shareholder protection insurance. So I'm going to put a title up there for you, and we're going to chat about this for a good 15, 20 minutes or so. You might have read about this sort of stuff in your CMAP book. So shareholder, we're looking at here, protection, cover insurance. Is where we're going with this topic. Now, you might have read a chapter in the book about cross option and buy and sell, and you probably got yourself all confused because it doesn't have anything to do with mortgages at all, and you probably forgot about it. But if you're getting into the protection marketplace, if you're looking to become a protection advisor, and you want to get really good at this, then this is the kind of topic that might crop up because we're dealing with businesses. We're dealing with small businesses, SMEs, who will need some protection. There's all sorts of things that businesses like that: key person insurance, a shareholder protection, all sorts of issues going on there. So let's dive into shares. Now we're talking of shares here in a small company. So we are talking about a private company, a limited company, if you like, private limited company with small numbers of shareholders. So we're talking about a family firm here, right, aren't we? We're talking about Acorn Associates, who happen to be a small limited company, so it's limited, so they're not traded on the stock market or anything silly like that, but they've got a number of shareholders. Now, shareholders in these small firms tend to be family members or friends or relations, but the shares aren't traded anywhere. They're kept within a close kind of situation, aren't they? So you might have here for this particular company, Acorn Associates, we've got say we've got three shareholders, three directors in the company. There you go. Let's just put them all in there for you as we can. And these directors, they're not related, but they're good buddies, and that's the way they are. And they're all shareholders. They're all company directors, and they all own a stake of the company. So that's the situation. You might come across this in your dealings, when you're dealing with mortgages or protection or investments or whatever, you come across this kind of customer. There's a lot of these SMEs in this country of ours. Now, the problem we've got here is that when one of those shareholders die, then their shares go off into their estate and get inherited by people. And the other two directors don't like that. They want to keep the shares owned within themselves, so they control the company, they can decide strategy, etc. So life assurance is brought in now, and critical illness insurance, to provide money to give back to the surviving shareholders to buy the shares. That's pretty much how it works, really. So the sums assured that we arrange go to the surviving shareholders. They get money, which they can then buy the shares of the deceased person and keep the shares within their collective ownership. So that's the concept behind it. Now, every company has what's called an article of association. So let's put that up for you. Articles of association. Here we are. Now, the articles of association, here you go, of association. There you go, right there for you. It's a legal document which determines how and where these shares go in the event of death and what happens to them, and it gives the rights of the company about how the shares are bought back and how the shares can be bought by the deceased estate and bought back into the firm. So first thing you need to do is to check the articles of association, and it will tell you how the company operates when it comes to buying back deceased person's shares. That's the first thing to do. Then what you need to do is lay out a plan. As a professional advisor, you need to lay out a plan. There's 3 steps to the plan. So let's get over here for our plan. Let's put our plan up here for you. This is our plan. 3 steps to the plan. 1, 2, 3. Step number 1 is to find out what the agreement is, where shares go. So check the Articles of Association, find out what the agreement is. Yeah? So check it out, have a chat, find out what the agreement is to see where shares go and how they can be bought back. What's the law on that one? Number 2 is to provide some insurance. So you'll be wanting to effect some insurance, some life assurance, in order to give money to provide funds to buy the shares. So you're giving insurance to the surviving dudes to give them money, insurance to provide the funds to buy the shares. And you'll do that through term assurance, probably, maybe whole of life assurance, a critical illness, of course, if you're looking at that issue as well. And the last one then is to assess whether there's some tax to worry about. What's the tax situation of what you've arranged? Now, obviously, you're not getting involved there. You'll get the accountant involved in that. In fact, you should be getting the accountant involved in this anyway. She would want to get involved massively. In fact, more than likely, you would have been referred by their accountant to do the business in the first place. So this is where professional referrals come into their own, don't they? So that's the plan. So the first one then is to make sure that you check the agreements. So let's talk about the agreements, because there are 3 which are commonplace, called buy and sell, cross option, and automatic accrual. You probably remember that from your CMAP. So I'm going to remind you what they are. So let's get a little green pen over here for you. First one then is buy and sell. Let's just do a buy and sell agreement. Now the buy and sell agreement is a compulsory arrangement which binds. It binds the beneficiaries and the surviving shareholders to buy and sell the shares that are gone. So say, for example, this dude dies, their shares go into their estate and get inherited by beneficiaries. The buy and sell agreement binds the beneficiaries and the surviving directors to buy and sell the shares. I said it's just a binding agreement. So it's easy to operate. You just provide money to these 2 dudes to pay the beneficiary for the value of the shares. It's not a difficult concept. But the problem with this one is because it's a binding one, there's no business property relief for inheritance tax. Now, inheritance tax, of course, is an individual thing, isn't it? But when you get connected to businesses like farms and businesses, there's often some relief against inheritance tax when you have a business that forms part of somebody's estate. Shares, of course, is the value of a business. Farms, the same thing. And you can often avoid inheritance tax or roll it over. There's definitely rules there. They call it business property relief for inheritance tax. But there is no such relief in this situation because it's binding. And that's just the rule, the way it works. So the second agreement, because that's what we're looking at doing here, we're looking at agreements. Let's make sure we know what we're doing here. The second agreement is the more popular one. That's what's called the cross option. There you go. Cross option. Now, the cross option agreement is pretty much the same thing, really. We're looking at the beneficiaries of the deceased person selling the shares and the 2 surviving directors buying the shares. So, it's a buy and sell situation. But because it's called an option, they put a time frame for this to happen. And if it doesn't happen in the time frame, it doesn't happen. So it's an optional thing. There's a get-out clause. And because of that, there is inheritance tax relief. There is business property relief on inheritance tax. It's allowed. So vast majority, of course, go that route. They go the cross-option route. Now, the last one for you is what's called automatic accrual. Let's put that in there for you. Automatic, as in automatic for the people. Tell me which band that is. Answers on a postcard, please. Automatic accrual. Do you remember postcards? They're a thing of the past, aren't they? Answers on the postcards. Stamped addressed envelopes. Yeah. Automatic accrual, though, is very different altogether. Now, this one is where the shares are actually inherited by the shareholders, and sum assureds are used to compensate the family. So what would happen here is if this dude died, the shares would normally go to the estate, but they're not. The shares go straight to the other directors, and money is provided to compensate the beneficiaries. So that's automatic accrual. Tends not to be operated so much. So there are your 3 agreements, really, that you need to work out. Remember, those agreements are contained in, there we go, the Articles of Association. And you'll chat to the accountant about it, and you'll draw up the right way of handling that sort of thing as well. So the next part of our plan then is to provide the right insurance to provide the money. And this is where you decide on like a term assurance policy, maybe, which might be the one to operate. You might operate a whole of life policy, maybe a flexible whole of life. Got to make sure it's index linked as well. Work out the value of the shares. Difficult thing to do. The accountant will help you with that one. See how much money is needed by the surviving directors to pay for the shares that have gone to the beneficiaries. What's the value of them? You'll need to make sure that the sum assured increases in line with inflation. A whole of life, of course, will last forever. Term assurance tends to do the job because invariably these directors will want to maybe operate for a certain time scale in their life. But of course, shareholders own shares forever. It's not employment as such, is it? But usually being a shareholder goes alongside being a director. So if they resign directorship, they'll sell the shares back before they die. So that's the type of product that you would choose. But more importantly, you would want to work out how to write the policy, how to put it together. And this is a choice of like life of another or single life in trust. All those implications come in. So there's various options. You could do life of another. So let's we're talking about insurance now to provide it. So let's look at how we can do that. So if I get a black pen here, and we'll put some policies in here. So what you might do is you might have a policy in this person's name. So let's put a little policy in here. So that's your life assurance policy. This person is the life assured. So, if that person dies, the money pays out. But the people that own that policy are these two. There you go. They own the policy. So that's life of another. So what happens there, of course, is when this person dies, he or she's the life assured, the money pays out, the money goes to the owners of the policy. So these guys get the cash, which they then use to compensate, to buy the shares that have gone to the beneficiary. They buy the shares with that money. Life of another, pretty straightforward. You could have 3 separate life of another policies, couldn't you? Nice, straightforward arrangement. What tends to be more operated now, though, is trust. And you do it in trust. So you'd have a single policy. So again, if we do a slightly different color here to give you some contrast. So the other one might be a single policy again, there you go, in which that person is the life assured. But this time the policy is not life of another. The policy is written in trust. And you'd put it in trust for the other directors, wouldn't you? So this policy would be in trust. There you go. So I'll put that in trust for the other directors plus the family as well. But the trustees would be those people. So the trustees would be the directors and the families. The trustees, of course, control all, don't they? And then put it into trust for the beneficiaries would be the directors. So run it through as always. This person dies. The trustees pick it up. So the trustees would be the directors and the family. The beneficiaries would be the directors. So they get the money. They would then use the money to pay off the family. That's how it would work. So trusts are quite straightforward to operate in that situation. You probably do a discretionary trust as well. So the trustees could change the beneficiaries. So if more directors come in later on down the line, you could certainly operate like that as well. So trusts work as well. And that's pretty much the 2 ways in which you would write the policy. You could do it where the company owns the policy. You could have a company-based policy, so the company is the policy holder. The money pays out to the directors on death, or the money pays out into the business on death of the shareholder. The company then would get a load of money which they'd be liable for tax for. So there's tax implications if you do it that way. So normally it tends to be an individually owned policy. Premiums paid for by the directors. The company could pay the premiums, of course they can, but that could well become some kind of benefit in kind. So there'll be tax implications if the company's involved in any way, shape, or form. Remember, these are directors, these are individuals. The company is an entity in its own right. So it tends to be the way you operate it, life and other, or own life in trust. So you need to take a look at the tax side of things, as always, of course. If individuals pay the premiums out of their own pocket, then there's no tax to worry about at all. If the company pays the premiums, and owns the policy, then there's going to be inheritance tax and national insurance problems for all parties, aren't there? Because it's effectively a business cost, so that might reduce the costs for the business. If the more money they pay on insurance, the less profit they make. There might be an issue there, but of course there's issues around inheritance, income tax and national insurance contributions as well. If the company tries to make a profit from this in any way, then the HMRC will want to get involved. This is not to make profit. This is purely to compensate beneficiaries of the deceased, because they've inherited the shares. That's entirely what this is designed to do. The final thing to talk about is critical illness, ill health. We talk about dying here. Now, you can have an arrangement to buy back shares of a seriously ill shareholder. If you think about it, one of these shareholders becomes seriously ill, like a critical illness, which dramatically changes their life, and they cannot therefore continue as a shareholder or director. So what happens here is you take an arrangement to buy shares of the seriously ill shareholder as well, and you operate what's called a single option agreement. So let's put this one down here for you. We'll squeeze this one in red. Can we squeeze that down there for you? Just about. I'll pop it over here for you. A single option agreement. Now, as you can see, the word single means that we're dealing with one person. And what happens here, of course, is the ill director, the director who's ill, she is required, the other directors, to buy her shares. That's pretty much the way that one works out. So the director who's ill, the single option agreement gives them the option to buy the shares from the deceased or from the very ill director. That would be known as a single option agreement. The ill director requires the other directors to buy the shares. It's built into the Articles of Association, but much more complex there because the person's still alive, aren't they? So that's the critical illness, of course, would be affected there. The critical illness policy would be affected to pay a lump sum to the other directors to buy the shares from the ill person. So you'd have to look at how the policy is created, how it's written, because although the person themselves will receive the money because they're the one that's ill, the directors need the cash. So you certainly want to make it into trust as well, so the other directors get the money. So that's an option there for serious ill issues. But the main one is dying. That's the big issue there, death side of things. So that's quite a long story, that really, isn't it? You're talking there about shareholder protection. Of course, this comes into the concept here comes into the shares, of course, being protected, but partnership protection is the same thing. We're going to talk about that in another video for you as well. So that end of that session. Bye. And we'll come out of the pre-recorded one. So that's the live stream. I hope you enjoyed that kind of excerpt of one of the videos that we're doing. There's a whole collection of these things for the usage of the boot camp, which teaches you the protection qualifications. As you know, the regulators are getting quite heavy on protection now, and rightly so. The LRBF are beefing up their CMAP 2, introducing their new protection qualification, which you should be doing. So we're providing videos and things like that for you. Other than that, not a lot's really happening in the mortgage market. I hope you're all well. I hope you're buzzing. It's summertime now. Kids are on school, aren't they? So lots of people are on the hollybobs. We saw that actually when we drove across the M5 on Saturday. It was packed. I mean, packed. The number of cars driving down to Cornwall and Devon. I think Cornwall's full now. There should be a big sign saying, "No more people. Cornwall is full." Imagine the number of people down there. Let's hope the weather keeps going, because a lot of kids having their holidays, and childhood holiday memories last forever, don't they? So let's hope the kids are having a lovely time. I'll wrap up on our live stream. We'll be back again next week for you with some more updates for you, some more videos on mortgages and buying, selling properties, all that kind of stuff. So have fun. See you soon.